Hey everybody, big sell-off in oil this week. April futures down 272 and a $5 range over the whole week. It's been a while since we've had a move that big in the market. It seemed to me it was mostly headline driven, mostly international things going on and much less about the minutia of the domestic oil market. But let's go ahead and look what happened this week in oil. All right, like as I mentioned, I think it was mostly headline driven this past week. We still have a lot of uncertainty on the oil tariffs. The Canadian tariff still stands at 10%, and again, I think that's doable for the time being. Hopefully that gets negotiated and hopefully goes away. The Mexican crude tariffs would be at 25%. That's been delayed for now until April as the two parties negotiate. Hopefully, again, they can come to some sort of agreement on that. But I think what the market's most concerned about is the additional 10% tariffs on China. Of course, there's a concern that there would be fewer things coming to the U.S. just in terms of the U.S. domestic market, U.S. domestic oil market. Fewer things coming into the country from Japan means a little bit less diesel demand. The ports aren't as busy. You don't have the long haul traffic as much if you don't need to move widgets all across the country. Again, I think that that's a reasonable case for now. Further on down the road, if we do start building more industrial complexes and whatnot, then that's when you get that demand back. So maybe it's a bit of give and take. We give a little bit of demand now and start getting it back maybe in the second half of the year whenever we start to see construction projects go on for these big industrial complexes. Russia Ukraine is still looming large in the news. We're still getting a lot of headlines. I think the market is still discounting these too much, but let's go through them real quick. Trump is now threatening Russia with more sanctions, and these would be sanctions on the banking sector. Other parts of the Trump administration are also talking about rolling back some of the price caps that are in place. So it seems like what the administration is trying to do, if Russia doesn't come to the peace table, there'll be more sanctions. And if they do come and there's some sort of agreed upon peace, then we can start rolling back the sanctions that are currently in place. And I think the problem is a little bit too with the price cap. It's a big deal, but it's not as much of a big deal now with crude prices in the at least WTI in the $60 range as it had been if crude oil was at 80 or $90, right? So there's a $60 price cap on Russian oil that it's a little bit of a complicated scheme, but it kind of goes back to the shippers and the ship owners and making sure that that price cap stays in place. So again, I'm sure Russia would like to get full price for their crude. That would be a good thing. Maybe a bit of a question still on who's going to buy it. It seems like Europe is still solidly against Russia. Speaking of Europe, it seems like they're building up their defenses. They're trying to put a lot more money towards building up their defense sector. If the U.S. does pull out of NATO, I think that's probably understandable. There's been a long line of reasoning coming out of Europe, saying that Russia's going to invade Europe and they need to be ready to offset that. So yeah, if U.S. pulls out of NATO, I can see why they would want to build up their defense systems. I think that makes sense, but it also makes peace a little bit harder when you see it makes peace a little bit harder if we were going to see European troops in Ukraine. So again, I think there's too little risk premium. There is a small chance of this becoming a wider war across Europe, and I think that needs to be priced into the market. I don't think that's being appropriately priced in just yet. OPEC Plus did bring back production. I think this was probably the main driver on the sell-off on the week. It shouldn't be a huge surprise to the market. The OPEC Plus had talked about it back in December. I think there is maybe a bullish slant to that. If OPEC Plus sees the demand is there enough that they're actually willing to bring back production in April, that's maybe a good thing. If they can continue to do that, and not pull it back right away, that might be seen as even more bullish for the market. And what I mean by that is Russia warned just on Friday that OPEC Plus could reverse the decision if there are future imbalances. Again, this is nothing new. They said that on the March 3rd statement. They said that back in the December meeting, that they're really going to look at the balance of the market and see if the market really needs those extra barrels. The Saudi OSP, the official selling price, was dropped for Asia, Northwest Europe, and the Med. They did not drop it for the US. I don't know if they're trying to send a signal to the US or what, but again, we don't take a huge amount of Saudi oil anyway. So these two, in my mind, seem to go against each other a little bit, unless Saudi's just trying to make sure that there's a place to put these April barrels by discounting them a little bit so that the market is willing to take them. I think that could probably be a decent idea. And these aren't huge cuts either. We're talking about 30 cents in Asia, 20 cents in Northwest Europe, and 30 cents in Med against the regional prices that they have them marked against. There's continuing ongoing concern about the Chinese market in general, just the macros economic situation going on in China, specifically in petroleum demand too. That's how it sort of ties back into our markets very directly. China's ramping up stimulus still. They just set a 5% GDP growth target. So again, that's nothing new or unusual. We've seen those 5% GDP targets in the past, definitely. So they're setting that, and usually when they set that, it's something that's within reach, right? They don't try to put crazy numbers out there. So that would actually be a good thing if China could get to a 5% GDP growth target, actually hit that. That'd be a good thing for global oil demand. The Feb CACs and PMI numbers improved this week, month on month, up to 50.8. So that's up versus the January number, but this is also pre-tariff. So keep that in mind. I think this will be a good bellwether. I think we should be watching that CACs and PMI number pretty closely next month to see how that stacks up once these tariffs go into effect. That's going to give us a huge clue, if we haven't picked it up from anything else in the meantime, about what's really going on in China. And then lastly, I think maybe the most underappreciated thing in the market is the Iranian surprise. The administration keeps saying they want to shut down the Iranian oil sector. I'm assuming they mean exports to other places. They're not trying to strangle the people of Iran, I hope. There's been a couple tweets going around, some statements by the White House talking about this Iranian surprise. So we don't know exactly what that entails. There's also been some talk about some sort of joint strike, military strike between the U.S. and Israel in Iran. So again, I think we'll do well to pay close attention to any Iranian headlines coming out over the following weeks and months. Here's the chart I got off of the OPEC website on their plan to bring back production. So if you can see the numbers on the left-hand side of the column here, this is sort of the starting point according to OPEC. And you'll find in the oil market, there's not a lot of consensus on what production is for these OPEC countries. And I'll show you what I mean here in just a minute. But let's take these for what they're worth for the time being. So this would say Algeria is starting point is 908,000 barrels per day. By the end of September 2026, they need to be up to 959,000 barrels per day, assuming there's the demand here to sort of capture this and allow them to do this. So you can see Saudi starting just under 9 million barrels per day and ending up just under 10 million barrels per day in September 2026. If you take these numbers and sort of add up all these countries, all the production that's supposed to come on month by month, it averages out to 137,000 barrels per day, which is a decent number, definitely, but it's linear. They're not trying to weight it. If they would have asked me, I would have said, maybe try to bring back more supply in the summer months when demand is the largest, and then already build into the system where you're not exporting as much, you're not producing as much in the fall when you have refinery maintenance going on, that sort of thing. So we'll see how this goes. Again, there's been a lot of talk within OPEC saying that this is sort of conditional. Bringing barrels back to the market is conditional. If there's the demand there, great. If there's not, they'll have a meeting and pull back whatever production they need to balance the market in their minds. So OPEC does have their own set of economists who run their own balances, and so they see things maybe in a little bit different way than the rest of us do, but I think they do have some pretty good insights, given the sales base that they have, and the people that they can talk to. So that's the official OPEC numbers. If you look at this chart here, this is data I've taken from a company called Petrologistics. They are my preferred source for production and export numbers, especially for OPEC countries and OPEC plus. If you're in the business, please definitely check them out. I think they're a great source. The way they track the barrels, the way they track the vessels is a great way of counting the production and seeing what's actually going on. But what I wanted to show you more than the difference in the production levels is, I think it's a great way to see the change that's gone on. So if you look back here in Q3 of 22, Saudi production topped out way up here, and then we're down here, just like I mentioned, just below 9 million barrels per day currently. So that's a 2.2 million barrel per day drop from Q3 of 22 through sort of the Q1 average, if you will. So I think it's clear to see from this that that Saudi has been carrying the brunt of the OPEC cut this whole time. And that's, if you're in the industry, that's probably not news to you. If you're new to the market, want to make sure that you see that. In a similar vein, if we take this peak sort of here in Q1 of 23 on the Russian chart to today, their production has dropped 775,000 barrels per day. So that's a pretty chunky number too, but you're talking about a baseline starting out in the 9 million barrel per day mark. Of course, there's questions about, one, can they produce? I think the answer is yes on that, but two, maybe more importantly, where does it go, especially if sanctions become more harsh through the Trump administration? So there are, I think, some lingering questions about bringing this back more from actually how do you get the barrels on the water. If they can come to a peace agreement on Ukraine, maybe it's not such a big deal. But again, I don't think Europe's going to be buying Russian oil anytime soon. That's what it seems like anyway from the headlines going on. So I just want to point that out to you. The other things I wanted to point out this week, these are the EIA numbers, demand side numbers, and I wanted to point out just how much the market is depending on Asia to pull its weight in terms of the demand change year on year. So this chart is coming from the International Energy Agency, or these numbers, I should say. I made up these charts myself based on their numbers. And these are from the November 24 EIA release, which is now publicly available to anyone who wants to download that. But what I want to point out is these two charts on the left-hand side talk about the fuel type. The two charts on the right-hand side are talking about the region, the demand change over the region. So let's go through this real quick. On the top here is showing gasoline, or maybe I should start with diesel. Diesel demand globally is about 27 million barrels per day. Year on year, the International Energy Agency thinks that will go up 65,000 barrels per day. On gasoline, I don't know if you can see that the way this camera is working out, but gasoline, again, they're expecting to go up 106,000 barrels per day on that. But I think what's maybe more important here is if you look at the LPGs and the ethane, and then you look at the naphtha increases, so 348 and 265 respectively, these go towards petchems, these go towards plastic, towards making plastics. So again, this is very Asian centric, all this growth that they're expecting. So if we come down here to the bottom and then look at, this is split up between OECD and non-OECD. If you don't know what that is, you can always Google OECD and it'll come up with a lot of stuff for you to read. Basically what that means for our purposes is America, Canada, Europe, Japan, Korea. There's other nations in there, but basically you can think of it as the West plus Japan and Korea. So this becomes sort of a East versus West if you will, with the exclusion of Japan and Korea, of course. But the point is, LPG and ethane is expected to go up 260,000 barrels per day in non-OECD countries. Naphtha demand is expected to go up 291,000 barrels per day in non-OECD countries. So again, that's another huge hint that you're looking at Asia for these increases in demand. Switching over, let's just highlight this too real quick. In the West, in the OECD countries, they're also calling for diesel demand to drop 193,000 barrels per day. So that's pretty significant. And all the demand growth, we said there's 65,000 barrels per day of demand growth in the forecast. Well, that's all based on non-OECD, right? And again, all coming from the Asian markets pretty much. If we go over here to the right-hand side of the chart, you can see it's a similar thing. So total Asian demand, the way they are Asia Pacific demand, they have this labeled, is about 36, 37 million barrels per day. That is set to increase 576,000 barrels per day year on year from the 24 numbers. Again, if you look at the non-OECD countries, that's expected to go up 600,000 barrels per day, while the Asian Pacific countries that are part of the OECD actually drop 24,000 barrels per day. So again, there's a lot of, if you want to call it a burden or expectations set on China, India, other Asian countries to really grow total demand. So I should say these numbers on the right-hand chart are total demand. So if you were to take up the sum of these fuel types, that's where you get these 30, 36, 37 million barrel numbers from. So hopefully these charts illustrate exactly how important the Asian economies are for this sort of demand increase. Again, on the supply side, the globe looks fairly well supplied already. If these demand numbers don't come through, you could have a major sell-off on your hands. OECD has been pretty flat over these past few years. We had, of course, the COVID drop, as you would expect. But then since 2021, OECD demand numbers have been really flat. Non-OECD is where all the growth is coming from. So it's nothing new this year that we're depending so much on Asia, which is the largest non-OECD region, to come through with this demand growth. So, again, it's nothing new. Last year, I think we were looking for very strong demand numbers out of China, and they stumbled a little bit, especially in the beginning of the year. And that sort of caused some early sell-offs, or some sell-offs, I should say, early in the summertime last year. The market certainly feels heavy. Here's the prices the EIA is putting out. So these are the domestic numbers, but versus previous years, everything looks a little bit weak. Of course, I took out these. You'll see in these charts they don't include COVID years where prices got ridiculously low, because those kind of skew the charts a little bit. So in terms of pricing after the COVID recovery, we're still looking at pretty cheap prices going on. So again, this would be conventional gasoline at $2 on the wholesale market. Gulf Coast ultra low sulfur diesel, ULSD, you're talking about sort of $2.25. So relatively cheap prices there. On the margins, as we mentioned, I think last week, heating season's over and you're starting to see the heat crack. So ultra low sulfur diesel and heating oil are pretty similar. Difference in the sulfur, but otherwise pretty similar. So we're getting a big sell-off in the heat cracks here, which I think should be expected. On the gasoline cracks, I think they're starting to bounce back as we start to enter into driving season, which sort of kicks off, mid-March into April. And we've got some big refinery outages going on right now at Bayway and Paulsboro. So I would think that you would see an increase in these gas cracks here moving forward. And then finally, here's that $5 range. If you look at these candlestick charts, from the very tip of this to the very bottom of this is just over $5, and the body, again, I think that works out to $2.60, but versus the previous week, you're down sorry, $2.76 week on week. So we totally obliterated that support line that I thought would hold in last week. I spoke to several other folks in the market. They were a little surprised too by the amount of the sell off. So it might be a little too much too soon, but hopefully I've given you some things to look out for in the coming weeks. Again, any signs of economic issues in Asia in general or China specifically, whatever this Iranian surprise is, we need to sort of stay on top of that. And of course, with the tariffs, we need to keep a close eye on the tariffs. So, unfortunately, I think we're sort of stuck waiting for headlines to see what to do next in the big market, in the domestic sort of weekly inventory type numbers. Not expecting anything too huge or too unusual just yet. But anyway, hope this sets you up good for next week, and hope you have a good week. Thank you. Bye.